Hey, welcome back. It's Jason Coleman, mortgage broker with Price Mortgage. Could interest rates explode much higher? That's what we're going to look at today. We're also going to be looking at First Guarantee Mortgage, who just filed Chapter 11 bankruptcy just yesterday. It was announced. Now, I found this article on Reuters.com or however you pronounce that. And it says here, just filed in Delaware on Thursday, said it laid off 80% of its employees and stopped making new loans. The company based in Plano, Texas, originated $10 billion in mortgages in 2021, according to a court filing. It entered Chapter 11 with more than $473 million in debt. The company that provides residential mortgages. It says here, on pace to originate between 5 to 6 billion in new loans this year, compared to 11 originated in 2021. It says seeing lower profits, resale of loans, causing the company to suffer 23 million after-tax net loss for the first 4 months of 2022. First Guarantee said its existing mortgages are serviced by third parties and will not be impacted by the bankruptcy filing. It says here about employees. The company laid off 471 of its 600 employees, according to court documents. First rate mortgage and the drop in home buying demand have contributed to layoffs in the mortgage department. So what is a non-qualified mortgage, non-QM mortgage? These are loans that are stated income or bank statement loans. They're kind of subprime loans where they don't use your income all the time, or sometimes they'll just lend off the value of the property or the rental income, like DCSR loans. So there are some of these subprime type of loans in our system right now, okay? So First Guarantee did a lot of that. They did a lot of it. And what's happening with rates, a lot of you have been asking me, well, why are rates falling and when the feds are raising the, Fed's funds rate? Well, that doesn't make any sense. Well, here's what's happening is the feds went out and they were buying $120 billion a month of mortgage-backed securities. That means when a broker funds a deal with, say, UWM sells it off to Fannie Mae, and basically the government and the feds own Fannie Mae or Freddie Mac. So if you look at Freddie Mac, it used to be a public company, privately owned. But after 2008, the government came in and took over Fannie and Freddie. So now they're government owned. So basically, the government owns the majority of mortgages in the entire country. So now the Fed says they're going to do quantitative tightening, which is the reverse of buying the mortgage-backed securities and propping the market up. And they said they're going to sell 35 billion or 32 billion mortgage-backed securities a month. So when they came out to do the sale of these assets to investors, nobody wants them because we're experiencing an 8+% inflation rate and they're offering 3% on these mortgage-backed securities. Well, who wants to go negative on their money? So there was no bidding on those mortgage-backed securities. So in order for them to unload their balance sheet, guess what? They're going to have to raise the rates, these notes, a lot higher than 3 or 5%. They're going to have to probably go up to 8 or 10%. Because investors want a larger yield, or they're not buying. It's just not happening. So if they do this, that will cause interest rates to go and double, maybe 10, 12%. And then where will the housing market be? Then how will interest rates affect housing? So if this does happen, and you are looking to buy a home, you got to get creative. And that's where we have to look back in history in the 1970s. So what's happening right now is very similar to what happened in like 1974 from the research that I'm doing. Now, I was only 5 years old back then. So you do the math now. We're not even going to go there. But at the end of the day, what people were doing in the 70s when they were raising rates, people with lower rates that wanted to sell their homes, they would offer, seller carrybacks. Maybe they paid off their home and they could offer a mortgage to the next buyer and carry that note for 10, 15, 30 years, whatever the deal was, until they could sell or refinance and they get paid off, right? And so the buyer would come in with a nice down payment, 35, 40%. Homes were much cheaper back then. So, you know, when they say, oh, the average rates back then were 10, 12, 18%. Well, the homes were only, you know, $15,000, $30,000. So, and the average income was still, you know, I think it was like $35,000, $40,000. So the debt to income ratios, the interest rates, not the same. It is not the same. 18%, you could still buy a house and afford your payment at a 15% interest rate back then. Now with a 5 or 6% interest rate, at the peak of the housing pricing, it's very difficult to afford a mortgage payment. You have to be making $150,000, $120,000 a year. Maybe you and your wife are working, but what if, you know, one of you guys get sick or go on maternity leave or whatever, you know, or lose your job or get laid off. So now how hard is it if you have to combine your incomes to make that mortgage payment right now? It's just financial, mathematically is very sketchy. So we need to see mortgage rates come down. And there are ways to get out there and take advantage of other people's low rates and whatnot, or people that had paid their house off, all these Californians that came in, and or investors that own they're cash heavy and they pay everything in cash. They might be able to carry you for a lower interest rate than what is right now or what is possibly to come. Now, another possibility is the feds could pivot, you know, maybe in September, right before the election, and say, see, you know, it's just games they play at the expense of the people, which is, you know, despicable. So I hope this little explanation about interest rates and the mortgage-backed securities was helpful. You can look on Freddie Mac's ticker sign today, and they're like 44 cents a share. No one's buying, hardly anybody's holding. Maybe they were 80 cents, 90 cents a year ago. But yeah, it's pretty piss poor if I don't say so myself. That's how mortgage-backed securities work. That's how interest rates work. If the investors aren't buying the bonds and getting the yield that they need in the current inflationary environment, then in order for the feds to unload their balance sheet, they need to sell those at a higher coupon rate. So where do we go from here? Nobody knows. Nobody knows. They could pivot and start stimulating again without any warning. That's what they do. Hey, look at California. They're giving out stimulus again. They're back on the renter moratorium again. Can you believe it? I mean, that place is just a mess. It is an absolute wreck. That's why I won't go to Disneyland over there. I don't even want to go to the beach or spend a dime in California because I don't want to support that type of government. I don't. And I know California can be a great place to go, like San Diego, and enjoy the beach, but hey, there's always Mexico. Hope you enjoyed the video today, and I appreciate you watching. Thanks for your time. Until next time.